Welcome to the webinar. I'm Roger Royse. I'm the founder of the Royse Law Firm. We're a business, corporate, and tax firm with offices in Palo Alto and San Francisco. And today, for our webinar, we have a very special guest, David Ehrenberg, the founder and CEO of Early Growth Financial Services, is going to be giving us a presentation on Startup Fundraising 101. This webinar is part of a series of webinars that we do here at the Royse Law Firm on a variety of topics, both legal, industry, and business related. And I would like to remind people that this webinar is going to be recorded, so if you want to listen to it later, you can find it on the Royse Law Firm YouTube site as well as Royse University. It'll also be available for download as a podcast in the iTunes store. A couple of housekeeping items. You'll notice in the right-hand corner of your screen that there is a dialog box. So if you have questions, go ahead and type your questions in. We'll take them throughout the webinar as they come in. And any we don't get to, we'll follow up at the end of the webinar or afterwards. We plan on going for 1 hour today, including the Q&A. So as I say, if we run out of time for you, I'm sure David will be available to talk to you afterwards offline. Just want to let people know that we have a couple of events coming up. This is one of a series of webinars. Our next event is actually our Royse Law AgTech, that's AgTech conference on May 11 at the Computer History Museum in Mountain View. So if you'd like to register for that, go to www.svagtech.org to sign up. So, as I said, David is the founder and CEO of Early Growth Financial Services. That's an outsourced financial services firm that provides accounting, CFO, tax, and valuation services and support to small and mid-sized companies at every stage of the development process. They have 450 clients nationwide, from Silicon Valley to New York City. As CEO, David has overseen incredible growth, leading Early Growth to being ranked number 13 in the Silicon Valley Business Journal's Fast Private 2014 and number 797 in Inc. 5000 for 2014. It's a very fast-growing company. David is an active speaker within the startup ecosystem, and his insights have been published in Forbes, Inc., VentureBeat, and more. You can follow him on Twitter at Early Growth FS. So David, with that, I'm going to turn it over to you.
Thank you very much, Roger. That's an incredibly wonderful introduction. So very, very much appreciated, Roger. Thank you very much. Everyone, we have a small number of participants that are on this webinar. So please, let's try and make it as interactive as possible. If you all have any questions or comments, please go ahead and just make those entries into the question field, and we'll deal with the questions as we're going through the presentation. And I'm looking for questions. I'm looking for feedback from all of you. So the more feedback we get, the better. As Roger was mentioning, my firm, or our firm, provides finance and accounting support to early stage technology companies. Our client base is about 90% venture-backed technology companies, and we support 15% of the national private venture companies in the country. And we think that this makes us by far the largest provider in this space. So hopefully we know a little bit about what we're talking about, but definitely let me know if we don't. Henry, if you can flip to slide 2. As I had mentioned, Early Growth Financial Services works with early stage technology companies. We tend to focus on the companies, on the industries that are hot at any given point in time. What I mean by that is 5 years ago, we had a lot of clean technology companies, a lot of solar and a lot of energy efficiency. 3 years ago, we had a lot of social media companies, companies like Klout and FormSpring. When the online marketplaces and the online fundraising companies started, we got a bunch of those companies like Indiegogo. Currently, we're seeing a lot of companies that are in the Internet of Everything, that are wearable tech, and we're seeing a lot of big data. but we're also seeing all the other trends that are going on right now. So over the last 6 months, we've got a surprisingly large number of new cannabis companies and new Bitcoin companies. So our client base tends to be a very strong reflection of whatever's getting funded in Silicon Valley at any point in time. We do 4 different things for our clients. We do strategic CFO services. So we've got 30 different CFOs across the country. And we're in San Francisco, Silicon Valley, LA, Vegas, Boulder, Seattle, Austin, Chicago, and New York. We do CFO strategic services. We do transactional accounting, the accounts payable, the payroll, the accounts receivable, all the day-to-day transactions for our clients. We do taxes, state and federal taxes, individual taxes, sales and use taxes, R&D tax credits, and we do valuations. And we do some higher-end valuations, but the valuation work that we do tends to be mostly the 409A, just the compliance, check the box. Hey, I've got a privately held company. I'm giving out employee stock options. The IRS and the U.S. government requires me to do a 409A valuation. So that's who we are. This slide talks a little bit about some of our clients. You've probably heard of some of them. But as I said, it tends to just be a broad cross-section of what's getting funded in any given time period. Henry, can you go to the next slide? We are going to be talking about today why companies raise funds, what the different funding options are, the fundraising process, and what investors want to see. Hopefully this makes sense so far. Roger, do we have any questions or comments?
No questions at this point, so go ahead.
Okay, we'll jump into it. Okay, so if we can move into the next slide, reasons to raise funds. There's really 3 primary reasons to raise funds. To accelerate growth, you want to have very, very quick growth, and you're not going to have that unless you have outside funds. You're really looking to expand your network, or there's some timing considerations. The important thing to think about when you're thinking about whether or not you should raise funds is, can it substantially help you move your company forward in a way that raising funds would not allow you to do? And there's a lot of companies that are out there in this country that get started every day that never raise a penny of funding. It needs to be a company that's going to have this kind of accelerated growth and that has the kind of potential that will attract outside funds. When you're thinking about fundraising, depending on the stage that your company is in, it will really help drive your decision. So depending on how far along you are, what you've done so far, and where you're going, there's different investor types that make sense at different stages. And we'll go through each of these stages. Obviously, the first stage is bootstrapping. And bootstrapping is just when you decide to start a business and you put your savings into it, or your personal resources, or maybe just your time, but you're not going out there and raising additional funding. If you are raising additional funding, the first place people typically go is a friends and family round. Henry, can you flip to the friends and family round? So a friends and family round is exactly what it sounds like. It's people in your personal network. Perhaps it's family members, perhaps it's close friends, perhaps it's acquaintances that you know are high net worth individuals who are willing to invest in your company. Perhaps it goes as far as a friend of a friend. These rounds, the friends and family rounds, are typically smaller amounts, and the company typically has a low valuation at this point in time. One of the important cautionary notes I like to tell potential entrepreneurs and potential founders is that if you're going to raise a friend and family round, make sure that if you lose the money, it does not destroy the relationship. It is incredibly important that you realize that over 90% of rounds raised at this point are for companies that fail. So the failure rate, regardless of your company, is very high at this stage. And although every entrepreneur and every founder thinks that they will succeed, because a friend and family round is going to those people that are close to you and in your inner network, I really caution entrepreneurs to think about whether or not this is going to destroy the relationship if they can't pay the money back. Now, at this stage, I really recommend going with some sort of convertible debt option as opposed to equity. We're going to talk about convertible debt a little bit later and what that means, but at a friend and family round level, you should really try to avoid putting a valuation onto your company. So if we go on to the next slide, the next level beyond friends and family are angels. And there's really different kinds of angels. An angel is traditionally someone who is a high net worth individual who actively invests in companies. But angel investors have become a little bit sophisticated. There's three different things to think about when you think about angels. Do you know high net worth individuals that do invest in companies, and do you think they'd be interested in your company? Do you know any angel networks? And an angel network is a group of angels that have come together to look at deal flow and to co-invest together and to monitor activities of a company together. In the Bay Area, there's several different angel groups, including companies, organizations like Band of Angels and the Life Science Angels and the Sandhill Angels. But in every market that we are in, there are very, very active angels. The angel community is incredibly active down in LA, and it's incredibly active in New York. But there is at least one angel group that we are working closely with in every market that we're in. Now, angel groups are good because it gets you in front of a large number of investors very quickly, but there's some serious drawbacks to using an angel group. The first drawback is that it can be like herding cats. There's a lot of different investors. They have a lot of different questions. You can get very mired down in the due diligence process. So one of the things I suggest for angel groups is that you make sure there's someone on point from that angel group that's going to be working directly with you, and that you're not going to have to deal with 10 or 15 individual investors, that there's going to be one person that's running the due diligence process, that there's one person that's going to be asking for reporting, that there's going to be one person that's going to be pulling together questions and queries, and that you're going to have one point of contact. Because if you have 15 angel investors who each invest $25,000, you don't want to have to deal with those 15 investors for the rest of your company's life. So that's an important thing with angel groups. The third kind of angel is super angels. And Henry, can you push to the next slide? Super angels are a new breed of angel investors, and we've really seen them come about in the last 4 or 5 years. And these super angels function a lot more like institutional investors. They do a lot of deals. They tend to be very familiar with common deal terms. They tend to have staff that will help them in their due diligence, and they tend to have a much more formal process. These guys are great because you get the advantages of an angel and that they'll invest at a very early stage and take higher risks, but they don't have some of the time delays that using an angel network or a traditional angel has, and you don't need to educate them. A lot of these super angels are very sophisticated in what they're doing and how they're doing things. Roger, at this point, do we have any questions on either the friends and family round or the angel round?
Nope, no questions, David.
Fantastic, Roger. As you move forward, and the different stages, the different types of investors should really be driven by what stage you're raising money at. So obviously, bootstrap, when you're first starting out, a lot of times the friends and family is the first money that you bring in. An angel round is when you have a more strong idea of what you're doing, you have direction, you have a plan, and you want to execute on some initial deliverables. And then the first more institutional round is typically a micro VC round. And Henry, can you go to the next slide? Micro VCs are also another new development we've seen on the fundraising landscape. We've always had super angels and we've always had micro VCs, but over the last 4 or 5 years, we've seen a lot more of these players, and they've become much more active in the market, and they're making much more of an impact on the market.
Hey, David, this is Roger. We've we've got one question here.
Sure.
Going back to your angel round, the question is, can we do a convertible note for an LLC? Do you want to take that?
Well, you're probably a better person to take it. I would say I wouldn't do it because it's going to complicate things down the road. But why don't you answer that, Roger, if you have a second?
Well, it's possible. We see those sorts of deals done. We see convertible notes in LLCs, and it is a little more complicated because if it converts at the time you do an institutional round with a corporation, then it's not that big a deal. It just converts into corporate stock. I have had it happen where it ended up converting into LLC interests, and that is usually a little more complexity than the investor wanted to get involved in. So the answer is yes, you can do it. It's just with LLCs generally, it's just a little more complicated. Do you have anything to add to that?
No, not at all, Roger. I think that's great. I think we should. There's probably some people on the call that don't understand what convertible debt is. And we have a slide later on, but we should explain it now since we're talking about it. And convertible debt is when you have an outside investor who provides money to the company, but it comes into the company as debt instead of equity, but it converts into equity upon a future round. So typically it'll be a very simple 1 or 2 page document. The Silicon Valley Angels and some of the different incubators have come up with different convertible debt templates. Something that we're seeing a lot right now that came out of YEC is a SAFE document. Not YEC, out of another organization in the area, is a SAFE document, which is a form of convertible debt. But this is money that comes into you, and then when you close a round at a future point in time, that money converts into equity at that point in time, but it typically converts into equity with a discount. So you can purchase that equity at a future point in time for a cheaper price than the new investors that are coming in. And we're typically seeing on these convertible debt instruments, we're seeing 15 to 20% discount. We're typically seeing an interest payment on the convertible debt, which is prime plus 2 to 4%. The convertible debt documents that we're seeing are currently 1 to 2 years in duration. And they typically have a ceiling, which means that they will not exceed the company will not exceed a certain valuation for the convertible debt. So the way that this would work is, let's say you're raising $1 million. Instead of raising it as equity, you would raise it as convertible debt, and then let's say a year from now you raise a round. That $1 million would get contributed to that round. But in addition, you would also give them a discount and give them an interest payment. Roger, let me know if there's any questions on how convertible debt works, and we can go back and talk about it. If you are an entrepreneur, I am a big believer that convertible debt is in your favor, because I have met very few entrepreneurs that are not able to create more than 15 to 20% in value for their company within a year to 2 year time period. I have a lot of faith that entrepreneurs can create and build a company and create a lot more value in the time period given to them in a convertible debt instrument than equity would afford. What I mean by that is, if you look at my other example of $1 million, if you've got $1 million, you start the company. At the point that you start the company, maybe your valuation for the company could be maybe $1 million, maybe $2 million. So if you took that $1 million in as equity, you would give up a tremendous amount of the company right up front. But if you spend a year with that $1 million developing your product, developing your go-to-market strategy, hiring key team members, building your brand, you're going to create a heck of a lot more value in the company at that point. And so you have a much higher valuation when you go to raise a round. Let me know, Roger, if any questions come up on that. It's kind of a complicated concept to explain if people are first getting introduced to it. Going back to types of investors. So bootstrap, angels, the next level is micro VCs. And we typically see micro venture capitalists that are starting funds that have between $10 to $50 million. They tend to be very heavily focused on seed and Series A investing. They're not exclusively focused on those spaces, but they tend to be very focused on those spaces. They also tend to have very strong industry focuses. Because they're smaller funds, they can't cover everything. So we see micro VCs that are focused on e-commerce or on wearable tech or on financial tech. But we don't see a lot of micro VCs that cover the whole spectrum. They invest typically in the Series A and the Series B. They will invest in the early rounds, but they will not typically invest throughout the life cycle of the company. So although they might invest in a seed round and an A round, they may not invest in your future Series B or Series C or Series D. Some of them do, but it's not very common. Let me know once again, Roger, if you have any questions on the micro VCs. Beyond the micro VCs, you have the more traditional venture capitalists. And these are the names that everyone has heard, the Sequoias and the Kleiner Perkins and the Mayfields of the world. But there's obviously a lot more than those top 20 venture capitalists. And what I would tell you to do when looking at raising money at this round is really understand what the different sector focuses are that the firms have and what the different partners within the firms are focusing on. And make sure that you do a very good job of understanding who are the right players and most appropriate players for you. So that takes us through the different types of institutional equity investors. If anyone has any questions, please let Roger know, and Roger will just jump in. In addition to equity investment, there's some other types of investment dollars that you can bring into your firm. Henry, can you move on to the next slide, venture debt? So venture debt is different from convertible debt. It is traditional debt that a bank will provide or a special venture debt firm. But in addition to providing money at a set interest rate, they also ask for warrants. And a warrant is an option. It's an equity option to basically purchase an interest in your company if your stock price goes beyond a certain price. If it hits a certain level, the option kicks in, you can purchase money. You can purchase pieces of equity with that warrant. And so it's a hybrid. So venture debt is a hybrid in a way between traditional debt and equity. Now, a lot of the banks that focus in the venture space have venture debt products. So banks like Square One Bank and Silicon Valley Bank and City National Bank and Bridge Bank all provide venture debt options. But in addition to these established banks, there are several venture debt providers that are not banks but just provide venture debt facilities. these folks are out there. I tell people that when they're raising a round, we tell our clients to always think about venture debt. It may not make sense in a lot of situations or in every situation, but it's certainly a way that you can extend your runway. It's a way that you can extend how long your company is lasting without diluting the company further with giving out huge equity grants. Because although there is typically a warrant, the warrant is typically fairly small. And so this is a nice way that you can actually increase your burn rate, increase the amount of time that you're around without giving up a ton of equity. One thing that's important to know about venture debt, however, is that as important as your business and your leadership team, if not more important, is the venture capitalists that have invested in you. So the venture banks and the venture debt providers tend to have relationships with the different traditional venture capital firms and some of the micro VCs. And they will, in a large part, make a decision on whether or not to loan you money based on that relationship with the venture capitalists and based on whether or not they have had success getting paid back from those venture capitalists backed companies in the past, historically. Okay, that provides an overview of the different sources of funds. If anyone has any questions on the different sources of funds, just let Roger know and we'll jump in there.
Yeah, we do have a question here. So how does venture debt compare to regular VC funding, and specifically with respect to the amounts?
And so venture debt is debt as opposed to equity with the warrants attached to it. And it's typically a percentage of the venture debt round. And it typically comes in when you are raising a venture debt, when you're raising an equity round. Have you seen certain ratios, Roger? You know, I don't typically see it more than 50% of the equity round, but are you seeing certain ratios, or have you seen certain ratios in the past?
Nothing that I could characterize as a rule of thumb.
Yeah, it's hard to say a rule of thumb. We typically don't see it for more than 50% of the equity round, but there isn't a hard rule of thumb. It's going to be based much more on what they think of your business and the total amount raised to date as opposed to the last equity round, and then most importantly, who your venture capitalist partners are.
Yeah, so you know, there's a couple different kinds of venture debt, so maybe we ought to pause here and talk about that a little bit. There are organizations out there that, when they say venture debt, what they mean is they're looking for a company that has very solid intellectual property that they can lend against, and then they'll take warrant coverage against that so that they have the upside. So, one percentage that we might be talking about is what is the amount of the warrant coverage, and it can be really high. It can be very high. I don't think I've ever seen 50%, but you know, and by warrant coverage, what we mean is that they have the right to participate, to convert that debt, or to invest in stock in the next equity round based on a percentage of the amount of the debt. So, for example, 50% warrant coverage means that if I loan you $100, I have the right to buy $50 worth of stock. That's what we mean by warrant coverage and by percentages. So I just want to clarify that because there was a question about the terminology.
No, I think that's great, Roger. And Roger,
okay.
The next slide is actually on convertible debt versus equity, and you heard my convertible debt explanation. Did you have anything to add to that?
No, why don't we go ahead?
Okay, fantastic. Henry, can you flip to slide 13, the fundraising game plan? Now, when you're thinking about the fundraising process, think about it like a sales process. So really figure out who are the folks that invest in companies like yours, who are the folks that invest in technologies like yours, who are the folks that invest in your stage. So if you're a seed stage or a Series A or a Series B, who invest at that stage, and who invests in the region that you're in. There are certain funds that just focus on New York. There are certain funds that just focus on LA. There are certain funds that just focus on California. But understand all of those different factors, the sector, industry, technology, stage, and region. Make sure that you have a really good understanding of all those different metrics, and then identify who are the different venture capital firms and the partners within those firms that you should be talking to. And once you identify those folks, and this is an exercise that ends up being a big Google document exercise or a big Excel spreadsheet document exercise, where you identify all the different firms and you identify all the different individuals, and then you need to figure out how to get in front of these people. And the best way to get in front of these people is to have a personal introduction from someone that they know and trust. That is the best way in, that's the best open door, but I understand that can be difficult. Most of these funds allow you to apply online. Certainly the angel groups and the larger venture capital firms do. That doesn't work very well though. You really want that personal introduction. So as part of this process, you also need to strategize about how do you get in front of these different folks. And there's different sources. Other entrepreneurs are great. People that you know that are in the ecosystem, entrepreneurs that have companies, companies that have been funded or haven't been funded, but that have personal connections. I'm a big believer in making sure you have the right service providers. So finding service providers who really understand this marketplace and who can help you with these introductions is very key. So using a firm like Royse Law or Roger as your lawyer gives you the benefit of getting a great lawyer, but he's also incredibly networked into the community and can facilitate introductions and can make those introductions. When you're picking your lawyer, pick a lawyer who can also give you that value-added service. When picking a bank, go with a bank that's really focused on the early stage ecosystem and ask your banker before you sign up and before you open accounts if they can make those types of introductions. When you're picking your accounting provider, when you're picking your HR provider, when you're picking your service providers, think about this. So first area to go to is other entrepreneurs. Second is service providers. The third is your advisory boards. When you're pulling together your advisory boards and the people that are going to be giving you consultation and mentoring you, pick folks that know people in the ecosystem and can make those kinds of introductions for you. And then use LinkedIn. LinkedIn is an incredible tool, but you can figure out which of your connections have connections to the folks that you want to get in touch with and who you can ask for introductions. But a warm introduction is much, much, much better than any other avenue for getting introduced to a venture capitalist. The next topic I wanted to talk about was milestone financing. When you're raising money, oftentimes I'll talk to entrepreneurs that are doing their initial raise or they're raising their Series A. And I'll ask them how much they're raising, and they'll give me an amount, and then I'll ask them why they're raising that amount, and they'll say something to the extent of, oh, that sounds like it felt like it was a good size for a Series A, or it felt like it was a good size for a seed, or I didn't think I could raise more than that. That approach is wrong. The approach that you should have when you're raising money is the approach of milestone financing. And I've written a couple blogs on this that are on our site. But the idea of milestone financing is every time you raise money, you want to raise that money at a higher valuation. So every time that you raise money, you want to give up less of your company. You want to have less dilution than the last round because your company is at a higher value. So that means that every time you are raising money, you want to raise it at a higher valuation. So when you think about how much money you want to raise, you need to think about what are you trying to accomplish? What are the milestones you want to hit? And those should all be milestones that get you to a higher valuation, and you should have a budget for how much money it will cost you to achieve those milestones. And I always tell entrepreneurs, figure in a fudge factor. Give yourself a 20 to 25% fudge factor, because things always take longer and things are always much more expensive than you originally anticipate. So those are two very important concepts, both the concept of milestone financing and the concept of the sales process for raising funds. Roger, does anyone have any questions on either of those topics?
Nope, we can continue.
Fantastic. So the next slide, Henry, if you go to the next slide, it's the fundraising process. As I said, it's really a business development process. I tell entrepreneurs to give yourself 6 months. Sometimes it takes a little bit longer, sometimes it's shorter, but start really early. If you know you're going to be running out of money in 6 or 7 months, then you should be actively engaged in your fundraising process today and very deep into it. The next slide, choosing your target VC. We talked about this a little bit, but you need to be very selective in which venture capital firms you should focus on. And there's a very large number of venture capital firms, so being selective, it saves their time, but it also saves a tremendous amount of time and effort on your part. By doing a little bit of research and gaining an understanding up front, you'll really be able to target your activities and not worry about or not focus on folks that really won't pay you money or provide you with money in the future.
Hey, David, we do have a question here. Going back to slide, there's a question about valuation, and the question is, how is valuation set at each different milestone? You were talking about these different valuation milestones. Can you respond to that?
Yeah, so valuation is a tough question. It's a hard topic. I have an MBA and I've done the CFA, and when you do those things, you look a lot at things like net present value and return on investment, and there's calculations that you can use in order to derive your value for your company and what your company is worth. Those metrics and those calculations really don't matter that much within the venture ecosystem. Folks may give it lip service, but it just doesn't matter that much. At the end of the day, the valuation of your company is going to be, what is someone willing to pay you for it? And that's going to be based on a lot of different factors. That's going to be based on your founding team and how strong they are and whether or not you guys have had successes in the past. It's going to be based in part on how hot is your sector. 5 years ago, clean tech was hot, and solar companies were getting incredibly high valuations. Now solar companies are lucky if they get funding. So it depends on part in what's trending right now and what's popular right now. It depends on how many other companies are out in the marketplace doing similar things and what their valuations are. There's not a set valuation that should be set up for, if you're raising on a seed round, this is the valuation you should have. At the A round, this is the valuation you should have. Those types of metrics aren't very relevant. And the other problem that we are having is that the different stages mean less and less today than they did 4 or 5 years ago. We're seeing very large seed rounds getting closed that traditionally would be considered A or Bs. It doesn't matter as much about the specific round as about what you're producing, who your team is, and what the general feelings are on the sector. Treat your valuation as a negotiation process. So the more investors that you have interested in the company, the better. And obviously you are trying to maximize your valuation at any given time. But it becomes a negotiation process. And unless you have very interested buyers that want to invest in your company, it's hard to do a lot around valuation. Okay. If that did not clear it up, let me know. We can go back to it. Let's go to the next slide, Henry, which is called networking. And we talked about this a little bit, but it's the idea of treating the fundraising process like a business development or a sales process. Once you identify those key folks that you're going after, networking to figure out how to get in front of them, either through advisory board members, other entrepreneurs, folks in your personal networks, or service providers. Let's go to the next slide, which is what you need to present to investors. If all of you are in the process of going out and raising money and you started that process or you're thinking about starting that process, there's two books that I really love that I like to recommend to early stage entrepreneurs. And just truth in advertising, and just to be completely transparent, both of these books were written by good friends. So I'll be completely transparent, so I'm pushing their sales, I'm sure. But the first book is by Guy Kawasaki. And Guy was the first public spokesperson for Apple Computer, and he started a fund called Garage Ventures back in the late 90s. And Guy is a very, very dynamic speaker. He's written a book called The Art of Start, which is all about how do you start a company in this area, how do you think about fundraising, what do you need to do, how do you do your business plan, all of those key components. Guy is also on YouTube, so you can just look up Guy Kawasaki Art of Start. It's about a 2 or 3 hour read. I consider it an airplane read. Very easy, but worthwhile and good data in it. The other book is by Mark Phillips, and Mark was a very successful entrepreneur and founder and CEO of a tech company, an internet company in Australia, and he had a very successful exit, and Mark moved to the Silicon Valley and started a venture firm called Arafora Ventures. And they're currently on their second fund, and Mark's book is called Inside Silicon Valley, How the Deal Gets Done. And both of these books talk about how you should do the fundraising process and what the different components of the fundraising processes are and what you need. Henry, let's go to the next slide, which is the key slides in your pitch deck. Because if you are going to fundraise, to start, there's 3 things you need. You need a pitch deck, you need an executive summary, and you need an elevator pitch. An elevator pitch is just 5 or 6 sentences, a paragraph or 2 that explains what your company is doing, where you're going, and what you need. And it's a 2-minute email blurb. Your executive summary is either 1 page or 2 pages, and there's set information that needs to be contained in your executive summary. One of the things that's interesting about venture capital is that at this point, venture capital has been around for over 30 years. It's a very established industry. The norms have become very established as well. If you are raising money from VCs, they expect for you to be prepared and prepared in a way that they want you to be prepared in. That means that you need these 3 components, but you need them to be built the way that they want them built. And both Mark and Guy go through in their books what your executive summary should look like and what your pitch deck should look like. And if you're not an experienced entrepreneur who's had 1 or 2 successful exits in the past, I strongly recommend that you follow their recommended guidelines in terms of what to present. This next slide talks about the key slides in your pitch deck and what should be included in your pitch deck. And of that, if we go down to the next slide, the financial slides, there are 2 key finance slides that you should have in your pitch deck. And Henry, can you go ahead and flip down to your top-down financial projection slide? Oh, and I should say that Mark Phillips has been kind enough to do 2 webinars for early growth on the different elements of the pitch deck. So he went through all the different slides that you should have in your pitch deck gives examples and talks about what should be on them. And that's on our site, so the earlygrowthfinancialservices.com site, and you can just look up Mark Phillips's pitch deck presentation. And he's done it a couple times for us, so hopefully it'll be easy to find. But there's two slides that are finance slides, and since I'm a finance guy, I'll talk about them. The first one is a top-down projection, and the top-down projection is just how big is the market opportunity. Venture capitalists don't invest just in good businesses. They're investing with the investment thesis that 5 or 6 out of 10 investments will fail, a couple will break even, and a couple will be big home runs. So they're looking for big opportunities. So what this top-down projection does is it shows what's the total opportunity, what's the total market. There's not a lot of weight to this, but it's your slide to be able to say, look, this is a market that's worth going after, and this is a huge opportunity. The next finance slide is a bottoms-up financial projection. If you can flip to that slide, Henry. And this is just your traditional budget. What does your forecast look like? The way that we typically see this forecast prepared is it's for the first year, it's 4 quarters, and then it's year 2 and year 3. Tends to be very high level, and it also tends to contain cash position and hiring. We also do a separate seminar, separate webinar just on creating this financial forecast that you can also find on our slides. The next slide is slide 22, is funding requirements, use of funds. And this is often something that you need to be able to talk about, but we'll see as a slide in the appendix. So that's a quick overview of how we see the fundraising process. Henry, can you flip to the last slide? That has my contact information if people have questions or concerns. But I'd love to get some questions if there's any questions from the audience out there now.
Yeah, David. So one question that came in is how important the size of the VC fund is when you're actually selecting a VC. And I think this goes to maybe a bigger issue is do you want, you know, if you have the luxury of being able to shop your deal and you have a lot of interest, are you better off with maybe a smaller venture fund that might give you better terms or better valuation usually, or a larger fund that is probably going to beat you up more on valuation? You have a view on that?
I have a view on that. You probably have a view on that as well, Roger. Do you want to give me your view and then I'll chime in?
Well, I think it's a mixed bag. It just depends. I mean, that's the tension. I mean, I think with the larger funds, one thing statistically, if you get a term sheet from one of the larger funds, you're more likely to close. You know, they don't give term sheets lightly. They don't give term sheets just to lock up deals. They give term sheets because they made a decision and they're going to close on it. So that's one advantage. The other advantage is I guess the perception at least is that they may have more opportunities for liquidity because they have a big name fund behind you. Tends to give a company some more credibility when they go down the road for their next funding round or for an exit. On the other hand, I find that the smaller funds they give you better valuations. That's the tension that I see. I mean, I think I'd rather take the lower valuation because I'm a lawyer, so I'm risk averse. So I'd take the lower valuation and the higher chances of success than the higher valuation and the riskier exit path. How about you, David?
I think that's excellent advice, Roger. I think when you're looking at your venture partners, make sure you really think about the decision, because this is going to be someone who's oftentimes going to be sitting on a board, and you're going to have tough times with your company. You're going to have hard times that you encounter. So I would say, in addition to looking at the size of the fund, also look at who the VC is and whether they can provide strategic assistance to your business or just money, and whether or not they have contacts that will be helpful down the road, and whether or not there's someone that you can turn to when things get tough. Is this someone that you want to be negotiating with when things go south? when you hit some bumps in the road. So in addition to thinking about the size of the funds, you should also think about who the people are that are investing and who's going to be involved in your company, because this is a very, very important and serious relationship. So I would say that Roger's absolutely right in his recommendation, but also think about some other factors when you consider it.
So what do you think, David, about foreign funds or foreign investors? We're seeing more and more of that in the Valley now. And that goes to the bigger topic of just alternative sorts of investment. There's crowdfunding. There's, I've even seen sovereign wealth funds, come in here. Private equity. How do you feel about some of these? I mean, because everybody in the Valley, they think that the angel round, the angel fund, and the VC fund is their financing path. How do you feel about some of the other paths?
I think if you're fundraising, you should think about all options. We're a big believer in crowdfunding. Indiegogo is a long-term client of Early Growth, and we're a big believer in Indiegogo in our business. We also have OUYA, and OUYA they had the second largest raise ever on Kickstarter, and we still have OUYA. They're still a client, and they raised $10 million on Kickstarter, and that allowed them to really get their business started, and it also allowed them to attract a bunch of top venture capital firms. So I think crowdfunding is something that should be thought about. A lot of our clients are actively getting money from crowdfunding. You need to research it, and there's different sites, and you need to pick the site that fits you. But I think crowdfunding is great. I think international funds, I think that there are certainly a lot of great international funds. We have worked with several of the different venture funds out of Europe. I have a high level of comfort in a lot of the funds that we've worked with. But I would caution you to do your research on the international funds. Make sure that you understand what their investment thesis is, and take a look at their prior investments. And certainly, if I was taking money from an international fund, prior to taking that money and signing that initial term sheet, I would want to spend some time talking to the other portfolio companies that they've invested in. Private equity venture capital is actually a form of private equity. So when you talk about private equity, there's a lot of different forms and flavors that private equity comes in. And it could be that you don't have a business that's a great fit for venture capital, but you have a great business that's a good fit for another type of private equity. So I would say do your research, understand all these different options, and see what the best fit for you is. And certainly be willing to try a bunch of different sources.
Okay. All right. So, David, I don't see any other questions here, and we're drawing towards the end of our hour. Do you have any final thoughts or comments you'd like to share with our attendees?
No, I'd like to thank you, Roger, for inviting us on, and I appreciate the opportunity to talk, and I hope it was useful.
Okay, well, thank you, David. I thought that was really interesting, and just by the number of questions that we've got in comments, I can see that we had an engaged audience. I want to remind folks that you can follow up directly with David at the contact information that's on the screen. This webinar is part of a series, so stay tuned. We do lots of webinars on various topics, legal, business, or industry related. And again, you can find a recording of this presentation on the Royse Law YouTube site, as well as on Royse University under Industry Webinars. And final reminder, May 11th, Computer History Museum in Mountain View, California, you'll find our second annual AgTech conference. So I hope to see you there. And with that, we are going to conclude the webinar.